Welcome, everybody. This is the first Simplify impromptu webcast with my friend, Hugh Hendry. We're going to be joined by our mutual friend, Tom, who is cutting a little close due to time zone miscommunications, but he should be popping in any moment. And this conversation was a byproduct. Hugh and I have danced around these issues for an extended period of time. This issue of like, what does it actually mean when we start talking about, is this the end game for places like Japan, right? The Bank of Japan's yields, the JGB yields began to rise. The yen has weakened significantly. We saw the first intervention last week. By extension, there's this broader issue of, have we printed ourselves into a hyperinflationary condition? And, you know, Hugh and I both have very strong feelings about this. There is a general, attitude towards the dollar that we were just discussing offline that is some variant of, the skepticism of, oh, well, sure, it's worked so far, but that's only so far. And so I thought this was a great opportunity to take some time out of our day and have a conversation about how we see this, how we understand many of the dynamics around what it means to talk about the end game for a currency, or what it means to talk about the end game for the very low interest rate environment. Have some discussions around this idea of, could we return to a commodity-based standard, either gold for oil type dynamics, et cetera. I just thought this was a great chance to sit down and talk about this as we're looking at inflation in the United States on CPI measures somewhere in the 8% range, on PCE measures somewhere in the 5% range. Germany just printed a PPI number that was off the charts. Japan has been unable to make its way into inflation, but that doesn't, into significant inflation. I think the latest number I saw, Hugh, was 1%, 0.9%. So the panic is setting in. The panic of 0.9% inflation is setting in. But with that as quick background, let's launch into this. And for those who are participating live, one, we are going to record this and re-release it. We will not mention any Simplify products. Hugh is smart enough not to know any Simplify products, and so we're going to make this through compliance very quickly and try to get this out there onto YouTube channels for general consumption. But if you do have questions, we have a Q&A feature. I would encourage you to put those questions into the Q&A. We'll try to come and answer them. But with that said, Hugh, let's get this launched. Welcome, first of all. It's a pleasure to be able to connect with you coming in from St. Bart's. You're looking well-groomed and wonderful as always. You've clearly taken my New York City decorators advice on the decorating your office, but it is so much fun to have you here. Why don't you give us just the quick background as Tom Roderick shows up for us. I think he misspelled his name. That's not how you spell Roderick, is it? Did Tom misspell his name in his introduction? He just disappeared. All right. So anyway, Hugh, welcome. Let's get started. This kicked off with a discussion of the flock of Luke and the idea that we have an inevitable collapse of the dollar system as we're ultimately being called to witness the folly of central bankers leading to runaway inflation. You've decamped to an island climb in order to escape the craziness. Was that the right call? Should we all follow you to St. Bart's where we can hop into our little minis and hang out in the open air because the dollar is going to collapse? Is it over?
So I do not believe that we are doomed. I don't think that is inevitable. My presence in St. Bart's, I want to say, is redemptive. I have been rehabilitating a very tired and overused mind. But anyone who is aware of Twitter perhaps has noticed my re-entry into the universe. I cannot tell you where my ideas come from because there is no Bloomberg terminal in St. Bart's. I think I'm drawing it down from the ether or something. But I've got lots to say. I think so. One of my tweets, which has kind of withstood the test of about 8 months, we had the triangle on the dollar yen, which And
Oh.
I always have to laugh. Mike, I think I want to say we're kind of cut from the same fold, or in proximity to each other. And before we opine, there is consideration and an examination, and we insist on a long appraisal of the risk proposition. And so Japan is interesting because when I say a kind of triangle type formation, and then it's simply, when I'm talking about chart formations, I'm simply talking about like reservation inquiries. I'm not in the city at that point, and I'm trying to work out how busy the restaurant that I want to eat at is. And so the reservation system for me is some of these silly lines that we squiggle on charts. But it's long defined. I called it this. The parameters of this triangle seem to define our generation. The Bank of Japan was, I want to say, the first of the principal central banks to commit itself to quantitative easing. And it was a long time ago. It stretches.
Yeah.
I want to say, you tell me this, Bank of Japan was kind of 2003. I mean, the Bernanke speech.
I would argue the first was 98 actually, but 2003 it began in earnest. But yes, the first interventions to weaken the yen on that front, I believe, started in 98.
There you go. So that's what is that? That's 25
years.
25 years.
Exactly.
So that's what I mean. It's a generation, and so it's having a go, and it's popped outside, and it's quite rightly it's elicited curiosity, and we're all going, okay, it's telling us something, and we're here, I believe, today. We're here to try and determine what it's telling us. Now, it's not there to serve to confirm prejudice. Prejudice is something risk managers have to fight daily, hourly, if you will. Can we arrive at any logical conclusions? Tom, when he joins us, has a logical explanation for where we are, and I will leave that to him. I found myself in discussions with Tom eager to say, yeah, this is what we've been waiting for. If you will, Japan is like an igloo in the Arctic, and they've been freezing cold, and in their desperation, they have spilled gasoline throughout the igloo. And for 25 years, they've looked at that solitary match and thought, shall we? Like, how cold are we really? And when we see that emergence, that escape emergence from that triangle, you think, oh boy, they're going to strike the match. So I was on the point of saying that, but logic pulls me back. Now I'm going to stop. Logic pulls me back because I want to say that the sheer magnitude of the capital markets, of the sovereign bond, and other debt markets, as well as, if you will, that mature democracies have created fire breaks which actually make it, I can't say impossible, but incredibly difficult to strike that match. And so logically, I conclude that it has to pull back again, or at least I have to find the logical explanation for how they could overcome the fire breaks that have contained and have prevented any form of Weimar, which is from a period which has almost no parallels with modern political economy.
So I love that intro. And Tom, welcome, by the way. Tom, I think you misspelled your name. Isn't it R-O, by the way?
I don't think I did. I think whoever set up the Zoom
okay.
misspelled my name. No accusations as to who did it. But
all right. I think that's at your end, guys. But yes,
there's a bit of a miscommunication. I got confused about the time zone, and so had to rush back.
Not a worry. We're thrilled you were able to join us. Okay, Tom, can you try to increase the volume on your microphone, or bring it a little bit closer to you?
Is that better?
The direct quote from you was "Tom volume shit." Okay, much better. Okay,
perfect. But just coming back to Hugh there, like, yeah, like the move in the dollar yen is fantastical. It's exactly what Japan would have wanted in the Abenomics era, but were sort of unable to do. Right? They failed. We've seen dollar yen at 125 before, but it sort of failed to stick there. But I think the difference now is that the US is looking to hike rates significantly, which means it's a lot easier to devalue your currency against them if you don't seek to do the same thing. And if you look at the chart of dollar yen and you kind of plot it against US forward rates. So if you look at like 2-year forward, 2-year US rates, you'll see that it actually tracks it pretty well. Basically you've got the Bank of Japan capping rates at close to zero in Japan, whereas the US is allowing rate hikes. And all the while, you look at Europe. Europe is sort of suggesting now that they're going to allow rate hikes. Australia, which is close to China, which is not doing that great at the moment, is persevering with rate hikes. And the only guys who are not doing it are Japan. And it's not surprising because they're the guys who've been in a disinflationary funk for the last 30 years almost. It is remarkable to see that CPI in Japan is still 0.9%, whereas you look across Europe, you look across the US, it's all at a very similar level of high single digits pushing on double digits. And so it does seem to an extent that Japan is kind of different. And if you do get to see these rate hikes kind of push through, maybe it is finally Japan's chance to kind of shine, to get that export engine back up and to reflate, based on the generosity of Western peers finally raising rates.
So I think that's really interesting for two reasons. One, you introduced this idea of the forward rates in the US very closely tracking the behavior of the yen. And it's one of these things that kind of jumps out at me exactly to Hugh's point, right? What are the fire breaks that are in place? It's one of the reasons why I'm largely in Hugh's camp, although I certainly think that this is indicative that something has changed, right? So the period of yen strength, particularly in response to risk off, has been something that I've been flagging for a while, has no longer really worked, right? It does not appear that the yen is the risk-off currency that it had been. I think that is very, very important. In terms of the immediacy of this move, it feels very much exactly as you're describing, that it is a byproduct of the move in US rates. It makes me wonder if there's a outstanding option position that's sitting out there that is pulling rates and rate vol in the US in the way that it is. Others have brought up the point that the dynamics of the high level of implied volatility within the rate surface in the United States could be responsible for as much as 70 to 80 basis points of the move that we've seen in the two-year point, right? The Fed and others have come out and started to hit on this. Did we actually see the yield curve invert in 2s, 10s? And the argument that they're making is that the uncertainty that's embedded in the front of the curve is manifesting itself in a higher term premium for 2-year rather than 10-year. That in turn is telling you that this is mostly about uncertainty as compared to anything else. Perversely, the Fed, I believe, is actually increasingly reacting to the surge in 2-year rates in the United States and forward rates in the United States and thinking that they are massively behind the curve. And this feels to me to be kind of the fly in the ointment. It's almost the mirror image, the exact same methodology as occurred in March of 2020 when I wrote a piece for Logica at the time called Policy in an Era of, or in a Time of Pandemics, and pointed out that the behavior of central bankers who increasingly use market-derived indicators creates this weird feedback loop, right? Where the market crashes, the Fed feels forced to respond. Now we're seeing almost the reverse, where the rate markets are selling off. The Fed is in turn interpreting this as inflation has gotten out of control, even if the traditional metrics, things like 5-year inflation break-evens, are not showing any signs of that. That this is being interpreted as, oh my gosh, we really have to hike very aggressively, even though the economy is slowing. everybody hold hands and say giant kumbaya. Hopefully we end up with a soft landing. It feels to me that part of that fire break that Hugh referred to is the US discovering that they can't hike rates in the manner that they expect because the economy is so structurally weak in terms of underlying fundamental demand.
Yeah.
What's your reaction to that, Hugh?
Me or Tom?
No, Hugh.
I've got the mic. I'm not dropping it. The 1970s was an extraordinary period of time.
Yep.
Stop.
I agree. That is where that conversation should stop. It was unique. It was different. Anybody who brings up is like, oh, it looks just like the 1970s. In my view, one has no idea what bell-bottom jeans look like, and two have absolutely no idea what they're talking about because it bears almost no resemblance.
Indeed. And one observation, my parents in 1980, so I'm holding to my promise, I'm not talking about the previous decade. In 1980, they acquired their house. They purchased a house which was in public ownership. You know, we lived in a project, and they purchased their house. It was part of the Thatcher revolution, and maybe we will find time to move on to solutions rather than just describing the predicament. But in using modern parlance, I want to call Thatcherism tokenism. Like, she kind of saw the power that comes when people own things. You know, politics is about changing, shaping, influencing behavior. And I want to say that my parents had never conceived in their wildest dreams that they would become property owners, right? And just dwell on that when you think of the world that we're in today, where debt is ubiquitous, and that again speaks to the fire break. But in terms of the unique observation points, unique point number one, the conflict with Ukraine and Russia, a risk-off event, and the yen has weakened, as you noted. A second observation point that we have noted, but worth recapping, is that Japan stands at odds with the rest of the international community in that it has not been subject to higher prices. I'm still resistant to use this term inflation, because inflation would suggest that there has been a monetary accommodation, and I have not seen such an accommodation, and rather I'm willing to shift on this, but for the time being I'm willing to draw that parallel that we're familiar with regard to the end of the Second World War. You know, the alien body invasion led to an almost unprecedented situation where we closed the entirety of the global industrial and manufacturing base. And then without warning, the largest country in the world shouted and sent checks to say, spend, at a moment in time when its service sector was still closed off. And so the price burst, if you will, the explosion in prices that we saw in 1946, but which was never met with a monetary accommodation, which is to say it was followed by recession. And we do not, to this day, talk about the inflation of the 1940s. I am still on that analog until the data series proves me wrong. But I cannot explain within that analog why Japan has not been recording significantly higher rates of price increase.
So there's two separate components there that I want to unpack separately. The first is this analog to the 1940s, which I actually think is a very good one. It was introduced in, Lynn Alden, for example, has done a good job of highlighting this time period. Others have done so. I might take issue with the 1946 designation because it feels to me more like what we did was compress the time period from 1939 to 1946 into basically 24 months, right? Where We enter into a global shutdown, a militarization where basically instead of producing tanks, we decide to produce PPE. Everybody needs their extra toilet paper. Everybody needs their face toilet paper. And then all of a sudden we decide, okay, let's try to keep the spending, in contrast to the rationing coupons that we introduced in the 1940s, right? So instead of saying don't spend or spend with limits and trying to allocate on the basis of the state, we instead sent out general purpose checks, said to everybody, keep spending, even as we're not producing, draw down inventories. And then when we turn this system back on, I would suggest that, you've heard me use this analogy. It's like waking up from a nap, right? As you get to the age that you and I are, Tom doesn't have to deal with this yet, but you wake up and yes, you're rested, but you're also stiff. You need to stretch. You need to take the time to say, I'm getting out of bed. I'm doing all these sorts of things. It feels like that's what's happened, that the frictional components are creating allocation dynamics in the rise in prices that, again, I completely agree with Hugh, that this is not quote unquote inflation, that this is not been accommodated from a monetary standpoint. If anything, going back to my intro, we're starting to see the signs of austerity. We're starting to see the signs that say we will not accommodate this. And, to me, that is missing a very important point. We often talk about inflation and real rates of interest, negative real rates of interest, as expansionary. That they themselves become inflationary. But really what I'm seeing at this point is the loss of purchasing power that's leading to destruction of real world, real unit demand. And that's no longer being accommodated through wages or fiscal policy or monetary policy. So it feels like to me that this could shift very, very rapidly.
Yeah.
Tom,
get Tom on, because he's the meat between the two big burgers.
Perfect.
The two big buns, rather. He's the burger, you're the buns. Yeah.
So I'm kind of more in the inflationary camp, I think, compared to the two of you. I think what you said, Mike, is right. We've seen, we saw the supply shock. We saw, government essentially support spending on top of that supply shock. And so we had a warlike period of inflation.
Yep.
Now, that's kind of happened. That's history. The way that markets go at the moment, things seem to be accelerating faster and faster, and time kind of shrinks. And so the question is, will that degree of government spending or spending from the private sector continue or not? So far, since we've had the war in Ukraine, you've seen Germany seek to spend vast amounts of money on defense. Instead of abandoning the green agenda, you've seen them basically double down on it. And so it seems this surge in fiscal spending from government has kind of shifted across the Atlantic from the US to Germany and to Europe. And the question is, will there be a next wave? Will you see the US go again? Will you see, so if we do see these high energy prices from this conflict with Russia, we've jumped from a war of humanity versus a strange virus to a more conventional ground war of the likes, we'd hoped that we'd seen the last of. And the response seems to be the same, aggressive and expansionary. The question is, if we see another supply shock in energy like we saw in manufactured goods, will we see the government choose to sort of cut back, or will we see the government attempt to subsidize their populace once more to be able to buy more of those goods? And to me, it seems the latter is more likely. Every time we get a kind of a supply shock, instead of letting discretionary spending go down because sort of more necessary spending increases, we see the government come in and basically subsidize it so that doesn't happen. And so, we've seen two waves of this cycle already. The question really is, for inflation going forwards, if we see another supply shock, are we going to see another fiscal surge?
So you introduce an interesting angle there, Tom, which I think is an important one to consider. And I would argue that part of the reason why the transitory inflation camp has been so discredited, and candidly, I consider myself in that camp. It just becomes a question of how long does it take, right? So I don't see a runaway inflation type environment, as Hugh and I were alluding to earlier. But I do think that you bring up a really important point, which is that the system is very fragile, right? So if an additional shock emerges, I can't disagree with you, right? That we are prone to have high fragility to an exposure like an additional energy shock that would then manifest itself in another wave of higher prices as supply is restricted, et cetera. But in the absence of that shock, do you see the underlying conditions as Hugh and I described, right? So we can discuss the probability of that event and how to incorporate it into pricing expectations. But in the absence of that stochastic outcome, right, another shock, do you see the conditions as inflationary or more likely to be disinflationary from here?
So I still see it as inflationary, even if we don't see these shocks, simply because it's like, in my view, you're seeing two kind of major changes in the way that the Western world is sort of engaging in its business. And those two things are a desire to do decarbonization and a desire to kind of disengage from this globalized world into one where manufactured goods are made at home. And when you talk about decarbonization, what we really mean is, changing the way that we get energy, changing the way that we drive around, to renewable energy and to battery powered vehicles, and essentially not expecting any productivity gain as a result of doing so. And so basically, I think that, in this kind of disinflationary world, the major factor that's been solved for has been price. Whereas I don't think that's the case anymore. There's another agenda which has risen where the focus is not on price; it's on changing the way we do things. And irregardless of whether you think it's a good idea or a bad idea, it does appear to be happening, and it does appear to be growing. And deglobalization, I kind of see in the same way. We're basically severing all these global supply chains for the sake of political security, not for the sake of price. And if we manage to kind of, reindustrialize Western countries, move supply away from China to the West, again, we're not expecting things to get any cheaper. We're expecting to spend an awful lot of money to basically end up in the same place. And I find it hard to see that as anything but inflationary.
Oh, Tom, Mike, I mean, crikey, no. I mean, you're simply you're hyping up hype, right? You are transmitting, forgive me, that's unfair, but it seems like you're transmitting headlines. And my counter is, you're describing higher costs. Mm-hmm. You're not describing a monetary accommodation, okay? So that, as we enter this second half hour of our program, and trying to discover the malaise. Remember, we are in a depression in the sense that the recovery in the global economy since the GFC has failed to even reach the extrapolation points of where we were headed until the calamity of the banking crisis, okay? And I would attribute that failure to the lack of monetary accommodation, that when people wish to discuss the demise of the dollar, this is lacking humility, but I want to suggest that they're lacking an understanding of how money works, that we're in the third innings, give me some US sports metaphor, but I want to say there's like 4 courses. This is the end of the third, which was the creation of the euro-dollar system from about 1965, and rest in peace 2008. And it hasn't been replaced. We do not have banks. We do not have risk takers willing or actively seeking to make commercial loans. And actually, we don't really have entrepreneurs actively, really buying the Fed's hype. I want to say to you, Tom, you said that the US really wants to raise rates. Whose US are you talking about? Are you talking about like the 12 grey guys who make up the board of the Fed and who always get it wrong? Or are you talking about the thousands upon thousands of people who kind of get it right and constitute the bond market, and they're going, you're too early, guys, you're too early. And so let's say Germany, like you say, I think Germany, fact, just now, enshrined in the German constitution, Germany is obliged to pursue a primary fiscal surplus. That will not be waved away. It may be eliminated. It may be legislated out of existence, but it's here for a considerable amount of time. They may indeed, and they have to build nuclear power stations and create freedom energy bridges to get them away from the devil's playground. But again, that's simply time. What I'm talking about is lending. When the government borrows, it does so via government bonds, via capital markets. The money creation that we're talking about is a bank loan. A bank loan, that money never existed before, and then boom, it's in your account. I'm anticipating 3.5 million euros. If my bank is listening, please, by the end of next week, will reach my commercial account for my activities on my building site. That money does not exist at this moment in time. It will. I am promised. That's the difference. I don't see Germany, creating that phenomena which we call the monetary accommodation, which can accommodate the household budget on these non-discretionary energy items which are, hitting the roof, and to go out, afford to, go to the cinema or take on all the luxuries that we feel obliged to consume.
Well, and I want to build on that for a second. So Tom, again, it comes back down to, I think for both Hugh and I, this dynamic of, there is what is being said and what is being asserted about the development of these parallel systems. And then there is the resistance to actually implementing that, right? And so the point that I would emphasize is that you are likely to be, I think both Hugh and I look at this and say, you are likely to be right in iteration 3, 4, 5 of this. But between here and there, we have to suffer through all the inherent dynamics. And I think Hugh labeled this really well. He said, the 12 gray-haired men, there's a few women in there now, and most of them dye their hair. But the simple reality is that they are old people, and they are not yet in the young avant-garde risk-taking framework, right? They're trying to protect a system rather than reinvent a system. And so that conservatism is embedded in their response. I think we're seeing it exactly as I was articulating before in their desire to withdraw it quickly. And the confusion that's coming from the market, in my analysis of it, is that policy rates have to respond. Policy rates for me are defined as basically anything inside of 2 years. It's basically determined by what the Fed is going to do or what people expect the Fed to do. The Fed has said very clearly, we are going to hike rates. In response to that, the policy rates have to move higher. If you just think about it in a binomial tree type framework, right? Every time the Fed hikes, you start from a higher initial condition. So any future cuts are going to be from that higher level. The market has to have a positive beta in response to that, but that doesn't tell you anything about whether it's the right policy. Right? It is the market reacting to the certainty that the Fed is going to move as compared to whether that is prescriptive. And the longer dated portion of the bond market, I think both Hugh and I would say, is saying very, very clearly, yeah, that's too early. The odds are very high that we short circuit this expansion and thrust us right back into the same mistakes, quote unquote mistakes that have plagued Japan and others. And in the process, damage future growth expectations, leading to even more accommodation being required before you can create the growth conditions that allow you to escape from this.
So firstly, I'd say in regards to Germany, what you spoke about, Hugh, was essentially the lawyers being in charge. I don't think the lawyers are as much in charge of Germany as they were before. I think you've got people in charge who are seeking to find ways around the rules to spend more money. And you've seen that, you've got supplementary budgets, you've got all of this stuff. Like whatever the laws are, whatever the legal situation is, like there's definitely a class of people who would just seek to evade those rules. And so I don't know. I don't really think we live in we're in a world right now where we're operating on a legal basis. In terms of the US, like I hear you, that when you look at like the US 2-year rate versus the US 10-year rate, the 2-year rate is starting to push as high as the 10-year rate. And I guess, to an extent, you can say the market has more say in where the 10-year rate is. And as you point out, Mike, the 2-year rate is essentially determined purely by the Federal Reserve. And so the market, to a certain extent, does agree with you, I think, in that they are not expecting persistent inflation, and they're not expecting that the US is going to be able to deliver on hiking rates to 3% without causing damage to the economy. Like, totally agree. That's what the market is saying. But, we have the inflation path as well. Inflation is currently 9% in the US CPI. We are pricing in a rapid recovery in inflation. If you look at 5-year forward inflation, that's, I think, like 2.5% at the moment. So basically, that's where it was throughout the entirety of the 2009 to 2019 period. It's basically, longer term inflation expectations are spot on the average of where they were in that previous cycle, despite spot inflation being significantly higher. And I hear you. It's certainly a possibility that, all of our supply issues are resolved. Inflation doesn't take hold in terms of wages, in terms of all these kind of constraints that economies might face. But equally, if inflation does stay high, those longer term rates are going to have to go a lot higher, because at the moment we're pricing in 10-year real rates at something like what I can't remember what it is at the moment, something like
zero,
very
right?
negative.
It's zero right now, right? Because the 10-year inflation expectations are roughly in line with the US 10-year rate.
Yeah, so we've gone roughly negative, which in that path where inflation returns all the way back to the average of the last cycle over a 5-year period, we are suggesting that the compensation in real terms for bond investors will be zero. Like, I don't know. I think everything's up for grabs at this stage. You could see a policy error either way.
I think a zero return is a fair approximation for the appetite for risk. So again, what I want to suggest, why are we in a depression? Okay, we are in a depression because of the lack of financial intermediation. People willing to take risk and create loans, create money. Why are they unwilling? We're unwilling because we have returned to base camp. We find ourselves back implicitly on the gold standard. It's got nothing to do with gold, but what I mean, the problem with the gold standard, which concluded disastrously with the depression. Gold standard, things which are rigid break. And when they break abruptly and unexpectedly, and they cause mayhem. And that fate befell gold. But what was the principal problem with gold, which was articulated brilliantly by William Bryce Jennings, the presidential candidate in the 1890s for the populist parties? We're being crucified. We, the common man, we are being crucified on this cross of gold. Today, replace gold with the renminbi, or replace it with mercantilism. I'm physically close to the United States, but the United States is confronted by trading partners which are determined to pursue growth almost exclusively via the external account. When your growth is determined by your trade surplus, it forces correction and corrective measures, both internally and externally, to essentially unskilled people. And then to compound matters further, the monetary authorities in the US took a decision which initially I was angered by, a decision in 2009 to launch QE and other unorthodox attempts to hold the levy. I've come to make peace with that, because in doing so, they prevented the Great Depression, but they kind of left a mild depression. I would still take mild. I'd rather not have depression, but I'll take mild rather than great. But implicitly, they made an assumption that they could not underwrite asset values going to zero, that they actually had to provide a floor to asset values. The asset values cannot fall, such is the magnitude of the debt, that the asset values are the collateral, and without that collateral value, the system implodes and goes to zero. They made that decision. I understand why they made that decision. But at a moment in time when the unskilled labor class is on a crucifix of renminbi, and at the same time, they have no asset to profit from the largesse of the monetary authority, we are reaching boiling point, which will reflect itself. It is reflecting itself. It's deep buried within the Ukraine-Russian conflict, but it's deep buried within the embrace of Trump, of Brexit, of a new German political system that you talk about, Tom, about like wanting to cut corners, like not being like determined by law, but by like exploring the future. That's where we are.
Well, so I want to hit on a couple of points, because I think both of you are bringing up really important dynamics that tend to be underplayed. The most important one, I would argue, is something that Hugh alluded to earlier, right? Commercial banks are not doing the lending that is required to expand the monetary base in the traditional framework. And I want to emphasize what I mean by that. We no longer have a lending system that is based on income. It is not, your lending is no longer measured against your borrowing capacity in terms of what is your income. What we are doing is we have a lending system that is based upon collateral. If I have no income and I've got a crazy amount of assets, you will lend me almost any amount of money because you consider the collateral to be far more important than what I'm going to earn in the future. Now that creates a perverse incentive in which those who are already rich have effectively unlimited capacity to borrow, where those who want to emerge on the ownership platform, Hugh's parents who have no asset except for their future earning capability, are discarded and treated as ineligible to borrow along the current structure, right? So that's the complaint system. And as long as you have that type of dynamic, what you really have to face is that the primary issue of a debt-based system, and again, remember things like limited liability corporations, debt discharge through personal bankruptcy, et cetera, emerged in the 19th century to facilitate the growth of that type of lending, right? You failed to have the income you thought you were going to have. Guess what? We're not going to stick you in debtor's prison, right? We're going to give you another chance. That's designed to facilitate growth. What we're doing today is perversely, we're creating restrictions on those who want to borrow on that basis. For example, students trying to build their human capital, and we're exempting that debt from the dynamics of discharge. And we're saying this is non-dischargeable debt. It's creating a permanent millstone around their behavior so that they can't afford to hit the market and try to buy those assets and create the inflationary conditions associated with a price wage spiral, which we're not seeing any evidence of. We're seeing a loss of purchasing power, not an increase in purchasing power in an attempt to meet it. So that to me is the single most important point, that we are lending against collateral as compared to lending against future income prospects. The second dynamic that creates then is that's just another way of saying, hey, we're further consolidating the resources in the hands of people who don't have to spend, right? Who have a low propensity to spend. That is Japan. That is what transpired in Japan, where effectively the market diverged. If you were a large, boring Japanese corporate that owned lots of real estate and had a terrible franchise like Office Copiers, right, you could borrow at functionally unlimited quantities. But if you were a Japanese startup that was doing something innovative, there were no funds available to you unless you went to the Yakuza and, obtained onerous rates of, 20+%, or you were able to fund it exclusively out of equity, right? Like I'm just seeing us move right down that path in the United States. I'll pause and Tom, let you respond to that, because it's from Hugh's head motions, it seems he largely agrees with my assessment.
I don't disagree with that, and I think it's a big problem. Like the further we get away from that debtor's prison style dynamic, the better situation we'll be in. And I think the problem has been on the other side as well. All of these large corporations, people who've had assets, can essentially have been able to outsource their need for labor to China and to the emerging world. And there's been that giant glut of labor, which sort of emerged out of China. A combination of a very young population and the one-child policy meant that you had this huge labor glut, which basically I think is the other side of the coin to what you're talking about, the asset is king, because essentially there was no, the worth of labor has been diminished in the West. And that's the other side of the coin to saying the worth of assets has been increased. Essentially the return on capital, or the ability to leverage capital, has been far stronger than the ability to leverage labor in the West. That clearly needs to change. And you can argue about which side of that coin it's easier to make that change from. Like for me, the easiest way to make that change is to essentially restrict the outsourcing of labor away from the West, and bring it back to home. And perhaps you're finally seeing that. You're starting to see some sort of stresses in the labor market. You're starting to see people on lower wages getting paid more. You're seeing minimum wage hikes in the US. And as a result, if you look at the lower quartile of wage earners, they're getting an 11% pay rise in nominal terms, which is actually exceeding that of inflation. And if you look at the people who are most stressed, they're going to be people in that cohort, right? And so we are finally starting to see wage hikes in that cohort. If inflation doesn't persist, the level of those wage hikes, because they're based on a shortage, will likely persist. And you'll see much, much bigger real wage hikes. Now, interestingly, that's not happening in Japan at all. I think, Japanification is one model for what people thought that Europe and the US would go down. The fact that Japan, even based on the enormous supply shock that we've just seen, has kept its inflation low. That inflation has not pervaded through society yet. In Europe and in the US, it has. And to me, that suggests that perhaps Japanification is not actually the way the West is going to go. Perhaps its economic structure is different. You look at China, I think it is going the way of Japan. Their population demographics are similar. They've got a strengthening currency into a worsening economic situation. Perhaps, the West can escape Japanification and that persistent disinflation, whereas China can't.
There are three solutions. Mike, I don't think you've heard. I think it's very important. Because I think I dare to say there's a lot of intellect on the bandwidth today. And therefore I think it's beholden upon us to suggest paths of redemption, paths of recovery out of this global mild depression. I want to suggest one path which will not happen. One path to redemption would be that China adopts the US role from about 1967, when the US, after decades of running current account surpluses, like surpluses on the external account, pivoted and began to run deficits. I would encourage Chinese policymakers to take that on, to allow to my mind, the Japanese get this tough time, but they allowed the currency to appreciate. I mean, we went from 240 to 100. Within that range, I want to say the renminbi's trading like at 180. Like it should be trading at 100. Their resistance to allow it to trade at 100, I think, would be like 4.5. So sorry, I'm jumping around between two cross rates. The fact that the renminbi dollar is not at 4.5, in fact, it's at 7.3-ish, means that they're still hell-bent on pushing this, if you will, deflation back into our lives. They will not accept it because they would have to open up and become a more civil society, and they're not prepared. Their theology doesn't prepare them for that at present. So I don't think it's going to happen. The second solution would be an intervention. If I was in charge, I want to run everything. I mean, I want to run the Fed. Now put me in charge of the Treasury, because then I'd have dollar responsibility. I believe that the US Treasury should impose a surcharge on mercantilist nations hoarding of US Treasuries. And that surcharge would effectively turn the yield that those sovereign reserve managers obtain. They would receive a negative yield, which is to say that they would pay us rent for our accommodation, our willingness to allow them to pursue external growth at our cost. And then lastly, and perhaps which would be perhaps more amenable to many, give up on quantitative easing. Okay, you haven't created $7 trillion of money. Let's do it. Like, let's call your bluff. Let's do $7 trillion and create assets to everyone in the community that doesn't have an asset. Let's give them it, which is to say the Treasury should take on a sovereign wealth fund, and you're applicable to join on the basis of being a member of the excluded. That's a means again of we have to get radical if we are going to confront and escape this blasted depression. What do you think, Mike?
Well, I think you hit on a couple of interesting points. First, on China, I think the interesting dynamic there is if China were to switch to running deficits, the implication is that you would see such a collapse in internal production that I would be very hard pressed to see them as being able to persist in that. And I think this is part of the challenge, right? Because their domestic market is not growing with negative population pressures and an extraordinary reliance on construction for the proportion of GDP. If you take away their external surplus, that creates such a contraction in production that I'm not sure that they survive it. But I broadly agree with your observation, right? It is completely patently absurd that a country that is experiencing a roughly 50% collapse in its population over the next 50 years, probably much more rapidly than that, actually, if we're honest about the implications of what's going on, that they become the producer to the world or remain the producer to the world is fundamentally flawed. And you've heard me address this on Twitter and elsewhere as highlighting that, the expression is all roads lead to Rome. There's no expression that says all roads come from Rome, right? It's not like Rome was producing everything. If you're going to sit at the center of an empire, you have to consume. You have to run a trade deficit. Yeah. And China, that is a solution set. I just don't think China's positioned to be able to do it, which is part of the reason I'm so skeptical of China's long-term impact on this front. Your idea of, let me just hit on the other 2 points quickly. Your idea of the surcharge, to me, that's just saying, hey, let's put tariffs back in place, right? I
think it's cleaner than tariffs. I think it's cleaner. I think it's more transparent. I do not want to throw sand in the cog of commerce, but there is a financial rent being charged already by these sovereign creditors on debtor nations like the US.
To be fair, I have spent less time thinking about your proposal. I agree with you that targeting the financial aspect of it is theoretically cleaner than going after the traded goods and services segment. That is more distortive. I do think that there is already an extraordinary amount of distortion that is manifesting itself in some of the behavior we see. For example, US corporations' ability to offshore labor, our ability to transfer intellectual property that was developed in the United States and move it to low tax regimes. Those are just mistakes, right? I mean, that's just poorly designed system. And so fixing that before deciding that we're going to radically restructure trading relationships feels like a very obvious choice that we have underutilized, but are starting to wake up to. And I would highlight for people that the Hugh's proposal, the characterization of capital controls, which is really what he's proposing for, underpinned the system for many, many, many years, right? It is, you do have to recognize that there are both rights and responsibilities associated with citizenship, one of them being, you know what, you shouldn't actually feel that it is your free capability just to pick up and take the resources that you generated domestically and ship them internationally at the drop of a hat.
Yes.
I think that's important. The last one in terms of the US sovereign wealth, I actually completely agree with this. And to me, this comes back down to the dynamics of we are actually facing wartime type conditions where when we talk about reshoring and rebuilding along the lines of what Tom is highlighting, we do need to make a decision. What are we trying to accomplish? And that's really what a sovereign wealth fund focused on domestic reinvestment would be all about. I don't know whether the right answer is $7 trillion. I don't know whether it's $2 trillion, $5 trillion, or what the right answer is. Again, I have not spent enough time studying it because candidly, I'm not in a position to influence it in that way. But I agree with you. Like what we need is the equivalent of Eisenhower's investment in infrastructure in the form of the interstate highway system that needs to be directed internally, not necessarily in interstate highway or rail transport or anything else, but in the process of facilitating and encouraging the reshoring of many of these products, which in turn strengthens the hand of US labor relative to the hand of labor elsewhere.
Tom, let me just say, we'll let Tom come in, but just on that final point, Mike, I think that's a little bit, it takes me a little bit to where I'm uncomfortable with the notion of, is it what is it called? MMT? MMT. Where I think that falls down, because I think, it falls down because Japan has pursued MMT for like the last 40 years. You know, its government debt to GDP is an outlier, and its currency up until like 2 weeks ago has remained very, very strong. But the second flaw of it is spending, which is undertaken by the government. Entrepreneurs kind of go, it's fake. I'm not going to follow you. I think the revolution that Thatcher, and let's co-join, Reagan created was an understanding and harnessing the power of giving people assets and putting it on the household budget. And my dare, we're not policymakers, but if we don't start this conversation, it's never going to percolate to their level. So let's start the conversation. And my dare to them is use the collateral of the $7 trillion that reputedly you have spent on this silly thing called QE. Use that as the collateral. And if we have another event,
I think we lost Hugh. Tom, are you there?
He's gone. Yeah, no, I'm still here.
Okay.
Yeah. Well, I'll just come in with what I was going to say in response to you, Mike.
No, that's fine. By the way, Simplify team, can we reach out to Hugh and just let him know that he's frozen and ask him to dial back in?
Hopefully he's recorded the rest of his speech, Hizan, so we can share it later. Yeah, so I hear what you're saying on the sovereign wealth fund idea. I think the best possible way of changing the way that things work is to find some kind of market mechanism. And one market mechanism that we've seen in terms of getting rid of carbon is putting a price on carbon, like, basically restricting the supply and allowing the market to work out what is the most efficient way in monetary terms to get rid of X tons of carbon. Now, obviously, this is a system which has been in place in Europe for a number of years and has seemingly survived the first run, at least, of oil and energy prices going higher without getting too critically hit. If you could design some kind of a system to put a price on negative externalities for some kind of deglobalization in the same way as you've done for decarbonization, that would be fantastic. I can't say that I've got an answer for how you do that, but I think that is that you need to find a way to sort of incentivize the market to make its own decisions in the most efficient way possible.
So I think Hugh is back. Is he? Hugh, are you live? Yeah. Okay, fantastic. So we missed the last part of your discussion there, and Tom came in and basically said, yes, I agree that that's actually a really interesting proposal, particularly on the sovereign wealth side, if it can be done in a manner that facilitates a particular outcome that's desired, right? Your observation around the Thatcherism component, which I think is really, really powerful, is it effectively said it took a nationalized system and said, you're trapped in a project where you're renting from the government. Instead, what we're going to do is step forward and provide financing so that you can capitalize that, you can create an asset, and you're, instead of renting from the government, you are effectively borrowing to own the property. You own it now, it's yours to maintain, it's yours to invest in, it's yours to borrow against, and you get to make the best choices around it. That's a liberation and a freeing up. But it does highlight the bigger picture, which actually one of the questions that just came in the Q&A, and I think is really important. Actually, the last two kind of hit on this. MMT per se is not a policy, right? It's a description of how the system works under a fiat framework. It is simply saying that debt doesn't mean quite what you think it means when you talk about the government. The question is that MMT raises is, this is possible. Now, how do you choose to spend it, right? And that's really what I would argue a big chunk of what we've seen is we used MMT to facilitate consumption. We said, hey, everybody, you're going to lose your job. Here's $10,000. You can go maintain your expenditures for an extended period of time. Because we sent that out in largely uniform framework so that everybody received it. Of course, those with the highest propensity to consume suddenly found themselves with a relative surplus, which led to excess consumption of durable goods at the exact same time that production and the logistics associated with it became stressed. Perfectly explains what we're experiencing. Those who sat through my podcast with Lacey Hunt got to see the example that I gave on used cars and new cars. And we don't need monetary policy to explain to us what happened. We know exactly what happened from that framework. But there is this broader question of, can we do exactly what Hugh is proposing, and can we spend that money in a way that is thoughtful and builds future productive capacity? I think it's a brilliant question, right? But it raises the question of, do we trust the people who are supposed to be making those decisions? And I think that more than anything else is where we would hear a resounding scream of no from the audience.
Yeah, but that's why you insist on you have to create the fund. The fund has to invest in the assets. You distribute ownership of the assets to the people that don't have assets in the first place. And you say to them, listen, wise counsel, hold on to this thing. The power of equity compounding, right? In the future, especially because we're underwriting the thing, it's going to be high. It's going to be higher. Like, China ain't going to change its way, right? So we're going to continue to crucify you on a cross of the external surpluses of the mercantilist nations. The only good thing is, because of that, asset values are going higher. Therefore, here's your chance to participate. But you know what? You can sell it. I mean, this happened in Russia during the transition from the anarchy. They were given the Thatcherism tokens in the public utilities. But of course, the smart kind of money chasers came behind and traded and bought all of those coupons from a naive public that weren't educated. And I think that partly explains where society in Russia and why it's ended up with the leadership that it has. Like, assets are such an important thing. And then finally on the subject matter, I want to tell you that Tom cited an absolutely brilliant innovation by the Europeans, the cap and trade system, which puts competing American systems to shame. Why is it in the socialist citadel of Europe they have no limit on speculative participation? Speculative participation is the participation of those seeking the truth. What should the price be, right? In America, the Californian scheme and the East Coast schemes, speculative behavior is limited to, I think, $300,000. It's unlimited in Europe. But apart from that, what the European governments explicitly did, they gave a transfer. They gave an asset, which is the right to pollute, with a value today of 150 billion euros, and they gave it to corporations in Europe which would be affected by that carbon policy scheme. They said, look, hey, we're sorry, and in compensation, here is the next 10 years worth of carbon credits. Let's start giving credits to the people who need it. It's not corporations in Europe, it's people who are renting, it's people who can't make the rent. It's people who are despaired, who are being cut off. Let them join our society and join, even if this wealth that we celebrate every day in risk markets, even if it's fictional, let's start sharing the dream.
Well, it's interesting you mentioned that, Hugh, because the areas that we have heard, particularly coming from millennials, that are important are things like student debt relief, right? They're starting off so far behind the eight ball that they're not able to accumulate the reserves to acquire the assets that you're highlighting. We're starting to see a break from that. So the latest legislation that's actually coming through is creating conditions under which corporations can, on a pre-tax basis, start to repay their employees' student loans. We're beginning to think about this, and this echoes something I mentioned on Twitter the other day, how hopeful my conversation with Harold Malmgren was, because we're starting to talk about what happens after the fourth turning. We're still in the midst of the disruption and uproar and frustration with a system that has become very clear was not thoughtful in its construction. And exactly as you pointed out, the reaction function of the Gavin Newsoms, et cetera, of the world is, his hair is better than Hugh's, but his policies are 10 times worse. You're looking at almost a degree of stupidity in response that it's somewhat helpful, because people look at it and they're like, that is the dumbest thing I've ever heard of. There has to be a better policy than that. Reaction to that, Tom? How do you think about that as the inflationist in the crowd?
Sorry, you just cut out at the end there. I didn't quite catch the end of what you're saying.
No, so what I said was, part of what's interesting to me about the dynamics of the U.S. response in terms of California's, and to a lesser extent, the East Coast response to high gasoline prices. Let's give every car $400, right? I mean, among the dumbest policies I've ever heard of. It's almost helpful because it's so absurd that nobody applauds it. Everybody understands that what we're doing is subsidizing and trying to prevent any form of change, right? Hugh started off with the wonderful, diatribe of, I embrace change, I love change, right? That's what we need.
Do you know what? Yeah, the thing is, I just think it's so tough, right? Because when you see societies who have managed to push through meaningful change, it's because the people in charge of those societies have been young. And I think we have, if you look at the demographics in the West, if you look at the average voter in the UK, the average voter is, I think, 61. And that makes it very, very difficult. And every year, the age of the average voter goes up by half a year, which means that those who are, closest to the innovations which are kind of revolutionizing the future are their voices are not being heard. And so I think that's the problem. We almost have a demographic issue. If you go through with a democratic vote where you have older people who are more inclined to vote, they don't vote for change. They don't want change. And so, you get politicians sort of like scrabbling around at the edges, trying to find something which won't lose them elections. And they don't feel like they've got the right to make those meaningful change because the youth is not big enough as a cohort to change things. And I don't know how we kind of get there. And I think it's sort of like it just makes the change in policy much stickier because what if you've got
But
the
Tom,
average age of voting.
you're talking yourself out of your inflation thesis. How can you run those? I mean, I'm all for running two contrasting ideas, competing ideas at the same time. But how can you make that consistent with you're the inflation in the room?
Well, despite that being the case, we still do have inflation at 9%. Maybe things have been very slow, but even so, we are starting to see some kind of shift. We're starting to see external enemies appear, be it a virus or the Russians or the Chinese. And that sort of forces change on a very sticky system, much slower than it should have happened otherwise. If we had a younger sort of demographic profile, I think the inflation would be higher and change would be quicker.
So I completely agree with the way you just concluded that. And I do, this is where I think Hugh is 100% right, that I would consider that argument. And this is part of the point that I make on the Bitcoin space, right? I mean, the embrace of deflationary currency by a younger generation under the argument that the money I make today, I should be able to save and have it preserve its purchasing power for something way off into the future, is so antithetical to their actual underlying interests, right? Because inflation effectively just says human capital is worth more than physical capital. It creates conditions under which you would expect your incomes to adjust upwards in in nominal terms, deflating the debt assets and creating conditions under which those who currently hold them, the older generation, are basically forced to part with them because they've lost their earning capacity. They're only earning off of capital, right? Like this is just one of these perverse dynamics where it feels like a generation has gotten itself so twisted around in terms of what actually matters that the manipulation to me is insane. But with that said, it does feel that this stop-start dynamic, and exactly to your point, Tom, we have an older voting class, but that's about to change quite radically, right? The wonderful thing about Nancy Pelosi at 82 is she can't stick around for another 82 years, right? Not that I'm rooting for anyone to shuffle off this mortal coil, but it seems like the only way we're going to get rid of the ice cream. So we are going to see that change, and the generation that Hugh and I belong to is a deficit, right? I mean, I'll lay this out candidly. We are here to be taken advantage of. We don't have the political power in Gen X to prevent the actions that we're talking about in the same way that the boomers did. So I do think it's about to shift. I do think it could change. And so at that point, I actually would find myself more in your camp. I do think we'll get the investment. I do think we'll get all that sort of stuff. I do hope, exactly as Hugh said, that we'll create conditions under which the US government says, you know what, we made a mistake in facilitating the growth of corporate rentals and corporate ownership of real estate in the way that we did. Let's change that, right? Let's actually, and let's do so under terms that are borderline punitive, right? As a capitalist, that makes me a little scared, but those conditions exist. That's how, by the way, the government got a lot of the properties that that Hugh's parents ultimately bought into. Is the government stepped in and said, fine, private sector is not going to expand housing opportunities. We'll build the properties.
No.
Right? Yeah, I think it was a great first half to an excellent policy prescription. The second half would have been to continue to allow new builds to enter the market. And that's been the bit which has been missing, right? Like, it's difficult to solve now. Like, I think it's something which is going to take 10 years for the building capacity to increase. There's a huge amount of regulation in the way, but essentially, if you want to if you want to reduce that asset base relative to incomes, you just need to build more.
But it's the inertia. We're trapped. We are trapped within. We're trapped. Like, the world today sucks. We're like, even all of us making money, we know it sucks. Like, it's trapped. Like Macron, the president of the Fifth Republic, the French president. You can change the world only if you make people rich. Yeah, I mean, Macron had this folly of pursuing much needed reform of the crazy, stupid French pension system, which allows ballet dancers to retire on full benefits at the age of 32 or something, and that's just a silly example. The folly was not what he chose, it was his timing. You do not bring on gut-wrenching change to society when the economy is in a depression. When banks are lending, expansion in bank lending it's averaged 3% the last 15 years in France. Do it the other way, like gun the thing, make people think this guy's a genius, and then say, hey, can we talk about changing the pension system, right? So my call to arms is, let's make the disenfranchised franchise them, make them damn rich. Imagine how our world would be today if all those disenfranchised were now the recipients of like this wealth fund, which had purchased the S&P when it was on its ass in March 2020. They'd be going, capitalism's kind of getting more interesting. Like, we need to hear that debate. I'm not hearing it, so anyway, God help us.
No, it's interesting, Hugh, you mentioned this, because I actually do think that we got a taste of that, right? I mean, that is the mania in stocks that peaked in, give or take, February of 2021, right? The crypto dynamics, where people decided, oh, I want to learn about the banking system. Now, many of the views that they've learned, I would argue, are coming from poor sources and represent misinformation in various forms. But it is wonderful when you think about what just transpired, that we created conditions under which people cared. Right, that they were actually interested in what was the performance of their assets. They were interested in their ability to be engaged in the system. Right now, I think we've squandered that opportunity, and it creates many of the challenge. Like, coming out of that, I think is going to become more challenging. So I want to wrap this up in a useful space in a couple of different ways. So one of the things that we had talked about is this the end case for Japan? I think where at least Hugh and I come out is that part of what's creating the dynamic in Japan right now is the dynamics of what's playing out in the US rates market. My perception of what's happening in the US rates market is that the Fed is misinterpreting and in turn creating a feedback loop where the expectations are for much more aggressive monetary policy, interest rate policy, and that is likely to result in a significant downturn in the economy that in turn means we need to start this whole process over again. Did that sound like a reasonable articulation of what you're saying, Hugh?
Confirmed, yep.
Okay. The second thing that, and so that should lead to a relative strengthening of the yen, and then we'll see where it goes from there. The second thing that we had talked about is the dynamics of inflation versus a rise in prices. And I think Hugh and I are both very focused on the idea that, yes, you'd have to be, as somebody pointed out, actually somebody being my partner, Harley Bassman, that you'd have to be, smoking a cucumber-sized blunt in St. Bart's to ignore the idea that prices have risen, right? Prices have absolutely risen. There is no question that the current basket as composed in the CPI and the methodology under which it's composed have created conditions under which consumption on a day-to-day basis is more expensive than it was a year ago or 2 years ago, right? The question of transitory is not a question of, are those prices going to retreat, but do we see in place the conditions under which we see sustained moves so that oil then goes to 200, then 300, then 500, then 700, because we've created conditions under which the collateral associated with the dollar evaporates? And the answer to that feels like absolutely not yet, right? Maybe we make the policy errors that get us there, but that's stochastic and unknowable from this point. And I would argue that I'm skeptical about it. The last component is this issue of what are the choices available to the rest of the world as it evaluates its positioning versus US monetary policy. And we promised a little bit of a discussion around this idea of gold for oil or a return to a commodity cycle, a commodity backed currency, right? And I'd love to, kind of put down on paper the reaction to that thesis that, China's going to, or that Russia is going to devalue oil to some ridiculous multiple versus gold, and everything's going to become about accumulating gold again. Let's start with Tom, because I know that Hugh is going to go off when we get to him on this. So, Tom, what's your principled reaction to this thesis?
So I think there's a big difference between what currency you transact in and what currency you want to accumulate. And I think gold does feed into that as well. If we just go through the kind of the transactions that would occur if you did have a major country building up significant gold reserves, what they basically have to do is buy gold off people who already own it. Pay in presumably dollars or a dollar-based currency to get that gold. And so there's still the issue about where the seller of the gold places that currency, because essentially it's just, gold essentially just acts as a feed-through mechanism to wherever anyone wants to ultimately store that wealth. So the price of gold can double. And that means the person who's accumulating it has been paying significant amounts of dollars to people who already had it, but are happy to sell it at the current levels. Those people then decide where to put that wealth. As it stands, people want to put their wealth in US dollars, in other Western currencies. The reason they want to do that is because they can. There's no capital controls, for one thing. And because those countries are providing innovation and assets that people actually want to buy. And, Russia can decide to back its currency by gold, but I don't think the fundamental decision about where people would rather store their money actually changes based on them doing that. And so, whether we don't even know whether they are going to do that. I think they may well do. I think it doesn't really make that much difference, except the price of gold goes up. I don't think it de-dollarizes the world. The only thing that will de-dollarize the world is if Russia, China, Saudi, or any of these other sort of mercantilist nations start producing assets which the rest of the world wants to buy. And as far as I can see, that's just not happening.
Well, and just to emphasize that last point, right? Assets as compared to consumption goods. Oil is a consumption good. It is not an asset. It is a consumption good. Oil reserves, right? An oil field, that is an asset. It is a depleting asset, but potentially is something that you could buy and own. But the reality is that the loss of the rule of law, the loss of any confidence that Russia is going to remain a good actor in good stead on the geopolitical stage, has, if anything, made owning the assets inside Russia far less attractive. So if anything, sure, they can have as much gold as they want, but nobody else cares that it's backed by that, because all you're really doing is addressing the credit quality issues for Russia. You're not actually creating a sustained demand or an alternative to the US dollar. So I'll pause there and I'll let Hugh toss in here.
Okay, so de-dollarization, and so the global economy, I'm going to kind of round up, is $100 trillion.
Yep.
Russia is fast on its way to becoming $1 trillion. It was historically about 1.7. Let's see where it bottoms out. So, in terms of tail wagging dog, it's a bit of a non-entity. And it's for China to decide whether it throws its lot behind $100 trillion or Crazy Vlad and $1 trillion. But I want to compare it to, you've got a neighbor, lives next door, giant house, And you're trying to work out, what does he do? Because you're in that neighborhood and you know darn well that every day you're working for the man. Every day you're up early. Every day you're in the office. You don't come back late. And every year, the guy next door, he just seems to be like watching TV. He turns up with like a new car, not just any car, like a Ferrari. And he turns up like with the most beautiful girlfriend. You're like, really, what am I missing? And imagine if actually that neighbor, he had a projector and he was revealing the answer every single day. He was telling you what he was doing and you just couldn't read it. That's how I look at de-dollarization. The world will de-dollarize when an economic bloc of substance, of size, of magnitude, embraces civil liberty, when it welcomes the transparent law of contract law. It says, you know what, you can own things. We cannot confiscate, right? There are boundaries, right? You the people, we the servants to the people, right? It's so easy. That is the magic sauce in the Coca-Cola formula for the United States government debt market. You know what? You're free to enter. It's the reason why every Chinese bureaucrat and technocrat, they dream one day of living in the house next door, the United States of America. So that's that point. Secondly, people people cram in a whole set of utility functions into money, okay? Money doesn't have to be the go-to place for everything. Principally, and the problem today is one of, you want money to intermediate. You want people to take risk and allocate funds intelligently, wisely, to create wealth. Our system kind of does it. Our system got really screwed up, the euro-dollar system. It got really screwed up because somewhere in the mix, we took away the punishment function. That risk without punishment led to an unlimited desire for risk, and therefore we ended up screwing the genius of our allocation system in 2004, 2005, 2006, okay? And we're paying the consequences. What I want to say to you, especially the Bitcoin crowd, money does not need to be a store of value. When you insist that money is a store of value, it takes you back into the hard, limited supply area of commodities. When you do that, you are putting the common man on a cross. Like, to preserve your wealth, you have to liquidate labor. And that's unforgivable. And it's come to pass. It will not happen again because we widened the franchise for people to vote. It used to be it was just the holders of capital that could vote could vote for political leaders. We all can now. And that has to be understood. So it's a confusion of the utility or the multifaceted purpose of money, which I think I'm ranting about.
No, well, I think that's actually a great place to start the conclusion, because we've gone a little bit over, but it is a very powerful statement, right? So first of all, money does not need to solve all problems, right? Money itself should not necessarily be a store of value. Hugh alluded to this idea that 0% real sounds like a pretty reasonable rate for somebody to store your riskless asset, right? It's the idea that there's hugely positive real interest rates associated with cash or with your currency is very much at odds with the way the system should work. The second component, though, that I think becomes really powerful in what Hugh said is the responsibility that we have as individuals with capital and assets in the current system, which is not working for a sizable fraction of the population. Historically, right, it's a terrible, terrible expression, that is linked to communism. It's, from each according to their ability, to each according to their need, right? That is disgusting. We know that, right? The fact that you have needs doesn't mean that they need to be met, right? Because they're mostly wants in most situations. But we also know that from a social standpoint, there is an incredibly important role. And when you do enter into a period like war, the elites need to offer greater sacrifices than the rest of the population. They have more to give to the common cause. And unfortunately, the system seems to be operating in reverse, right? Where the elites reacted to COVID by fleeing, the elites reacted to COVID by moving to protect their ownership of assets. The elites reacted to these dynamics by shutting down small businesses, preserving large businesses, et cetera, right? Like that's the core of what is ultimately going on. This is not a giant mystery. At some point, people have to say, okay, I'm going to make the sacrifice and reinvest. I'm George Washington. I'm going to turn down being king because I want to make the system more stable long-term and create something greater than myself. It sounds terrible in many respects, but it is a reality. There is a responsibility that comes with winning the lottery to the extent people have. And we're just not yet seeing that awareness. This was a wonderful, wonderful conversation. It's going to be available on release from Simplify. It'll also be sent to both Tom and to Hugh for release on channels as they see fit. I appreciate all the registries. We had over 300 that attended this live. This is really wonderful. I appreciate everyone showing up on short notice. Hugh, thank you for the proposal, and Tom, thank you for joining us. And I really do actually look forward to being able to do something like this again soon. Let's the three of us will get together and talk about ways that we can expand on the solutions component and try to address some of the questions that came in. But again, thank you so much for joining us. Really appreciate it, everybody.